So we want to welcome you. My name is Jennifer Young, and I'm with University Credit Union in our mortgage department. And joining me today is Taylor Riley. He's one of our mortgage consultants at the Brickyard office.
Hello.
He's very quiet. It's the day after a holiday, and we're all just so happy to be back to work. Hope you had a great weekend, and thank you for joining us. We're going to be covering today accessing the equity in your home, and there's a lot of information that goes behind this, and we're going to cover a couple of different scenarios. But just so that a couple of housekeeping items, we are going to cover and answer questions as they come in. So if you have a question, y'all responded to us, we appreciate that, but if you have a question, type that in and we'll try and address it as the scenarios come up. We may delay just a little bit if we're right in the middle of explaining some things, but we'll try and get to those, like I said, as quickly as possible. So again, thanks for joining us. We're going to jump right in and get started addressing and identifying what is equity. So Taylor, what is equity?
All right, equity is the difference between how much you owe on the value, or excuse me, how much you owe on your home and what the value of your home is. So you can be able to see what we have here with the value of $500,000. If you have a balance of $200,000, you would subtract the balance from the value, and that would give you the equity. So in this situation, we have $300,000 of equity.
So we get questions from time to time of, how much is my equity? And what we do to figure that is whatever mortgages, whatever debts are owed, whatever liens are owed on the property, and those can come in different formats, whether it's a mortgage, whether it's a tax lien, whether it's a property tax lien, sometimes there's additional assessments. We subtract all of those debts out, and whatever's left over is that equity. And there's lots of different ways, and we're going to cover a couple of those.
So there is a variety of ways that you can be able to access your equity. Some of the things that we'll be discussing is a cash out refinance. This is a first mortgage, taking the current mortgage you have and replacing it with another mortgage to be able to pull out some equity. The other option is to look at a second mortgage. A lot of times people think of a second mortgage as a second home, and that's not the case. Second mortgage means it's in second lien position. So this would be behind your first mortgage that you currently have. We would leave that in place, and it would allow us to be able to lend in second lien position. That's the same for a home equity line of credit. Home equity line of credit and a second mortgage are very similar, but they are different, and we'll go over how those are different. And then the last thing is a reverse mortgage for those who are old enough to be able to qualify for that.
So before we go too much further on this, we want to make sure that you understand what each of these are. Now, Taylor alluded to the cash out refinance. I'm going to have you explain just a little bit more of why would somebody do a cash out refinance? How could they access equity that way?
Yeah, there's a variety of reasons that we would look at a refinance, a cash out refinance. I like to ask questions and allow the conversation to move organically as to find out what option is going to be best. A situation where somebody might be looking for a cash out refinance is I would ask them what their monthly finances are, if they're comfortable with their monthly payment. Second mortgages have shorter terms. So when you get into dollar amounts that exceed $30,000, the payment can really start to become cumbersome on your monthly finances. So a cash out refinance typically has a monthly cost that's going to be cheaper because we're able to extend the cash out portion you're trying to take over a 30-year period. We also look at the rates to see where your current rate is to what the rate is going to be. Do you want to look at going from a 30-year possibly to a 20-year or a 15-year because of how long you've been in your home? So there's a variety of different ways how we can be able to find out what's going to be best for you, but that's where we will go through this organically and find out if a cash out refinance is going to be in your best interest.
So one of the biggest differences between a cash out refinance and a second mortgage, what's the loan to value limitation on a cash out refinance?
It's 80%. A second mortgage does allow you to go higher. So that's where when we're calculating our numbers, a second mortgage sometimes will stare us right in the face that this is going to be the best option very early in the conversation.
And a second mortgage, the limitation is what?
We can go up to 100% value of the home.
Great. And a home equity line of credit is the difference between a second mortgage and a home equity line of credit is an important point, I think, to cover as well. A second mortgage, what's the terms on a second mortgage? What are the terms on those?
So the biggest difference between, in my opinion, the HELOC and the second mortgage is that the second mortgage has a fixed rate where the HELOC has a variable rate. They're very different products, so they have different guidelines in the way that they're set up. The second mortgage, I forgot
Has
what the
a
question.
fixed rate and term.
Oh, the terms, excuse me. I apologize about that. So the terms that we have on them are 5-year, 7-year, and 10-year options. So when you're looking at how much you're going to be borrowing, we need to look at the rate on the term that we're looking at in terms of years, and that'll allow us to establish a payment for you. The home equity lines of credit have different options in how they structure their payment. So the products, after we take them to the point that they're second mortgage, the products are vastly different. So when we're looking at what you're trying to accomplish, that's where we'll ask some questions and it will guide us to what products.
So one is a fixed rate product. The second mortgage is a fixed rate, fixed term, and the home equity line of credit is a variable rate. And the term is a little bit more structured, but it's still, it's a variable rate loan. So you can, and it's like your credit card.
Yes.
Excuse me, I have a frog in my throat. You can charge it up, pay it off, charge it up, pay it off. And so you can utilize it over and over and over.
Correct.
But it is a variable rate. It's tied to market. So,
yes, and unless you're disciplined with it, the home equity line of credit, it's very difficult if you're not, as I said, if you're not disciplined to get it down to a zero balance. The second mortgage has a term on it. You'll have a payment each individual month. After you make those payments, you will be at a zero balance. So it really just depends on what you're trying to accomplish in terms of accessing that money. I'll give you a quick example. If you know that you're going to need $30,000 to do a remodel of a kitchen, and that's all you're going to do, a second mortgage with a fixed rate would be in your best interest.
Right.
If you are thinking about doing a kitchen, a basement, a couple bathrooms, you're not sure how much it's going to cost you, it probably would be more beneficial to go with a home equity line of credit, and you can be able to go through and start fixing those items. And once you know what an amount is that you're going to need for the whole entire project, that's when we can switch that home equity line of credit into a second mortgage or possibly even a cash out refinance at that time.
So the reason thank you, I kind of put you on the spot there for that, but I think it's really important to know the differences with these different items, these different loans, to make sure that you really understand that we sit down with you and we counsel with you and find out and identify your needs. And we're going to go into more detail. Taylor has put some time into presenting a situation where you can see the detail that we'll go into. We really try and identify what's going to be in your best interest. We're going to give you lots of ideas, but then it's up to you to decide what's in your best interest. But we're going to move forward and give you, I'm just going to have Taylor cover. There are a lot of things that affect the need for accessing the equity in your home, and these are some of them. So
yeah, absolutely. These are things that we have conversations with people and we talk to them about, and this is what they're pulling the funds out for. A wedding or college is a big one. Growing families to be able to finish basements. Most homes that are built, what would you say, after 1980, they really didn't have a finished basement. So finishing the basement, upgrading, or home maintenance. HVAC systems can cost $20,000, roofs $30,000. So home maintenance, to pull the equity out to be able to pay for some of those things are needed. Building wealth or purchasing a second home. We have a lot of people who have their first mortgages paid down to a very small balance or even paid down to zero. And some of the times they come in and they're thinking about buying condos in terms of investment or buying a second home. The rates and terms are going to be better on a primary residence than they're going to be on an investment property. So we look at possibly refinancing and pulling money out on a first home to pay cash for an investment property or a second home. And then also having emergency preparedness. One of the big things that I've talked to a lot of people about recently is earthquake insurance because of the earthquakes that happened in Bluffdale a few months ago. Well, when you get earthquake insurance, it is much more affordable than it used to be. I received earthquake insurance recently, and I think that my premium's less than $400 a year. The thing that comes with it, though, is that there is a 5 to 10% deductible for the cost to be able to fix the home. So when you're talking about $20,000 to $40,000 in cost, having that home equity line of credit there to be able to access that if needed is something that you can have. So we can be able to set these up in a variety of ways to be able to help you with what specifically you need at this present moment.
So we do the same, I feel like the same thing applies for home equity line of credits. We call them HELOCs. There's always an acronym for everything in mortgages, but HELOCs are a great source of emergency funds. A lot of times when we talk to people and they're facing an emergency, not always can they qualify And so I'm a big believer and advocate that every homeowner that, that owns a home, every person that owns a home should have a home equity line of credit attached. There are some great benefits to home equity lines of credit. There are no fees on them. It doesn't cost you anything to get them set up. They can sit there and you can leave it there forever and never touch it. And yet, if you need it, it's accessible immediately. So you can do a phone call, you can get online on our website and transfer the funds, and they're in your checking account immediate. And so to have those accessible to you, I think, is a great source of emergency funds. We do have a lot of our members that use it for cash flow. If they own a business and they do need some help from time to time for cash flow, they run into that and do that. And then future and short-term needs. A lot of people use it, again, for cash flow for not businesses necessarily, but just personal cash flow. We have a lot of people that have commission type or bonus type structured incomes, and sometimes it's plenty and other times it's shy, and they use their home equity line when things are shy. So
the other thing that I've noticed a lot of people with their home equity lines of credit is that a lot of employers have started going to high deductible health plans. And so when you've got costs associated with medical with these deductibles that can be $3,000 to $8,000 a year out of pocket, these are the types of things that can be able to help you. So getting a home equity line of credit is not going to cost you anything up front, and it can be able to sit there. If you never need it, fantastic. If you do, it's there to be able to help you. So I agree with Jennifer. It is good to be able to have those in case of an emergency, or also what you're looking to do in the future.
So the second mortgages run right into the same reason. These are just reasons that we've run into that people are most interested in getting it. But Taylor's also taken the time, and I'm going to have you go to the next slide or the next section. So Taylor's taken the time to put together a scenario, and I want you to just be able to see what the scenario is that they've put together. So
yeah, this is one that I went through. A big thing that we have with FHA loans is that starting, was it 2014, the mortgage insurance is on there for the life of the loan. And so when we have people who have FHA loans, their rates are really, really good. Especially at that time when they were purchasing homes, their rates could be in the low 3%. However, you need to take a look at the full picture and what's going to be beneficial for them. So these individuals, they bought a home in February 2016 for $238,000. Their original loan amount was $230,000. They currently have a balance on the FHA loan of $220,000. Over the past 30 months, they've remodeled and used some credit cards to be able to pay for that remodel. And so you can be able to see the balances that they have on their mortgages and what the rates are and what their total payments are. The big thing that they have is they have a $163 mortgage insurance premium. And so when we went through, the members were asking for an additional $15,000 to be able to finish the remodel of the main floor and the bathrooms. And so the total cost of the current financial model is the mortgage insurance was $162.99 per month. For 330 months is what they had left. That's $53,000. So then we looked at the credit card and what it would typically be over a 10-year period. National average for somebody to pay off a credit card is that's the time frame that we're looking at. So $42,000 in interest. So when we look at what the total cost was going to be over their lifetime, they're looking at $454,000. Okay, so the solution, we looked at two of them. We looked at a 20-year loan, we looked at a 30-year loan. In this situation, at this time, the rates were much higher than they're at right now, so that's why it says a rate of 4.875. But we had the new loan amount with the new payment and what the total cost was going to be for the individual. So no mortgage insurance was needed, so that was going to save them $162 a month. The total cost of loan savings was going to be $47,000 a month, or $47,000 over the lifetime of it. Plus, they were going to have the $15,000 cash in hand. On the 20-year loan, their payment was only going to go up by $47 a month. So you can see they went from having 330 months left to only having 240 months left. So they were able to skip 90 months and get the $15,000 and only pay $47 more a month. The other option, if they wanted to be a little bit more conservative with their monthly payment, was to go with the 30-year loan option. So you can see what the new payment was going to be at $1,595. So they were able to save themselves about $325 a month, plus get the $15,000 and be in a situation where they could be able to have a little bit more affordable payment, plus finish their remodel. So these are some situations that we were able to take a look at and give somebody options Do you want to go with option A and be a little bit more conservative with your payment on a 30-year? Or do you want to go with option B, keep the payment around the same as that you're paying right now, get the money for the remodel, and then you can be able to save it with the lifetime of the loan? So we like to go through and give people options so they can be able to find what's best for them and their family and what they're trying to accomplish.
So I love seeing these scenarios because it just goes to show you again, that's why we're here. We're here to help you go through the process, make sure that you're covering the information, that we're covering the information that's helpful to you and answering the questions and addressing the concerns. So is there anything else that you can think of on home equity lines or seconds or accessing the equity that's important to be able to present to these guys?
Well, there's so many scenarios that I can think of just off the top of my head, but the most important thing is if you have any questions on what you're trying to accomplish, you want to give us a call and talk to us, because we can be able to sit down and we can do it over the phone, we can do it in person. It's much easier to do it in one of those two options. You can kind of do it through email, but we like to go through it and we ask, how much do you owe on your first mortgage? Do you have a second mortgage? Are you paying mortgage insurance? What is your current rate on your home? We can be able to go through and start to formulate a plan of what you're trying to accomplish. What is your primary goal of what you are trying to do? Are you trying to get a cash out to be able to take care of something? Are you trying to lower your monthly bills? We can be able to go through all of those situations, and it organically allows us to be able to go through and find what option is going to be best for you. In a lot of these situations, we really just allow you to lead us down a road so that we can be able to end up at a product that works best for you. We're not trying to sell a product that doesn't work for you, because there's always better options that do work for you. So we're just trying to find out what's going to be best for you to improve your financial well-being. Every single person's different in what they're looking for. Also, what you think that you might want or might need is actually not what you want or need, because of when we go through and ask these questions with the answers you give. A big one that we have a lot of times, people are saying, we ask them what they want to do. They want to lower their amount of time that they have left on their loan. Well, when we start going through their finances, what they care about most is that they want the lowest payment possible, because they feel financially strapped at the present moment. And we can be able to help them with that. So we just want to get you into a place that you feel comfortable. And if the home equity line of credit without a balance on it is the best place for you right now, by all means, we just want to make sure that you're in the best possible position.
So we have a question. What is the minimum credit score for a second mortgage or a home equity line of credit?
This is where loan to value comes in. The answer with the second mortgage is 660. And then the home equity lines of credit, they can be able to, I believe that they go down to 640.
600.
600. Okay.
On the HELOC.
All right. So it really just depends on what the loan to value is on the home. So those are some questions that we can be able to answer for you if you do have some credit challenges, to make sure that we're finding the best product for you in a quick amount of time. We don't need to take weeks or hours or days. We can just be able to take care of those things with a quick phone call.
Cool. You know what? We really don't have any more questions. You've done a great job covering the information. We're going to give you just about a minute or two, and if there's any additional questions that come in, just really quick, if you do have questions and you want to talk to a mortgage consultant, you can see on the screen, these are a portion of our mortgage consultants. Reach out to them. If you dial the 800-481-8840, you're going to get a mortgage consultant that automatically answers. But if you do have a specific relationship, you can see Taylor Riley up there. He's at our Brickyard office. And if you have questions, you can reach out to him or any of the other ones that are convenient for you. So, and we don't have any additional questions. See, Taylor, when you do such a great job, they don't ask questions. So
one thing that I would just recommend, if you are in any situation or know anybody that's in any situation where they're thinking about an option, I would give one of our professionals a phone call and just have a quick conversation with them, because we really can be able to answer these questions quickly and go through this within 5 minutes to see what option is going to be best for you. There's so many times where I have conversations with people. I had one the other day. Oh, this was awful. This gentleman, he had been thinking about refinancing his home because his interest rate was over 6%, and he'd been thinking about it for 3 years. But the problem that he had is that he was thinking about selling his home at the same time. we could have rolled the closing costs into the rate, so he could have lowered his interest rate and he still would have been able to sell his home and it wouldn't have cost him anything. And once I told him that, you could see the pain on his face. But that's one of those situations where just talking to him when he said, well, I'm still thinking about selling my home. Perfect. Why don't we do the refinance and roll the closing costs into the rate so it doesn't cost you any money out of pocket? And we applied right then. It was one of those things where he really had been thinking about it for over 3 years and had spent probably $10,000 more than he needed to on interest. So we just want to have conversations to be able to help you out.
Yeah, this is a really good question. Heather, thank you, appreciate it. Is the credit score for a cash out the same as a second?
No, it's not. So as I said, loan to value comes into play. This is one where we want to get a little bit more specific with some scores and stuff like that. But as long as you have above a 620 for a first mortgage refinance cash out, we can be able to take care of that. So 620 is the score for that. Sometimes if you're a little bit more credit challenged and could be below that, we can also take a look at possibly an FHA loan. FHA loans are great products to be able to help people. They're more streamlined, where whether you're a 580 or an 850, which is perfect credit, they treat you the same. So we can be able to take a look at those different scenarios. But 620 is the number that I would have in my mind right away for that.
Yeah, that's a really good question. Heather, if you have questions on that further, reach out to Taylor. He would be a great one to work with for you. So thank you, I appreciate that. I know that there was another question that popped up in my head and I was going to remember to ask, and I have totally forgotten it, which is pretty typical. I think that's it.
Okay, one thing I wanted to focus on. So the second mortgages and the home equity lines of credit, as Jennifer said, they don't have any fees to set them up. So if you're really thinking about getting a home equity line of credit or thinking about tapping into your equity to do a small project, even if it's $10,000, $15,000, $20,000, those don't have any fees to be able to set them up. They don't have any fees to be able to talk to us. Neither do the first mortgages, but just to be able to go through the process and get it done, there's no fees that are attached to the loan. So if this is something you're thinking about doing, then let's take a look at it, because there's not going to be any costs that are associated with doing the home equity line of credit or the second mortgage. So we can be able to set those up for you. They're very quick, within a few weeks, and we can be able to have that money for you. You can just start making your payments back.
Okay, the last thing I was going to do is just throw a challenge out there to you guys. Interest rates are really good. And what is it that you've been saying, Taylor? Interest rates now are...
Oh, yeah. So a big thing that happened where a lot of people get confused by this, and it's not their fault, and I'm not blaming the media either, but there's a lot of different rates that are involved. Prime had been going up dramatically in 2018. And so the news that you constantly saw is that rates are up, rates are up, rates are up. Well, that was true for mortgages as well, but they're actually 1% lower than they were at their 2018 high right now. They're over 1% at this point. And so a lot of times, and there hasn't been any news stories that are saying rates are down, because prime did go up a full 1%. So if you think that rates are higher than where they have been in the past, that's not accurate. So we can be able to look at all options that are available for you, so that we can be able to get you taken care of on
that's
that.
just a plug for, if you haven't evaluated your mortgage within the past year to 18 months, you really should give us a call, because with the increased values and the better interest rates, we really are in a position where we can help you a lot.
Absolutely. And the biggest thing that we can be able to help people with a lot of times is the mortgage insurance. So even if you bought a home 6-8 months ago with values going up, sometimes we can be able to get cheaper mortgage insurance for them. I have some individuals right now where they're thinking, or we're doing the refinance, and they were concerned that their loan to value was going to be under 80. Even if they're at 85% loan to value, their mortgage insurance is dropping from $130 a month to $36 a month. So they're saving themselves almost $100 just with that right there. So there's a lot of different options that we can be able to take a look at to see what's going to be best for you, because it's not always about evacuating it in its entirety, but being able to lower that premium quite a bit.
Oh, lots of fun going on in the mortgage industry. Sorry, frog in my throat today. Listen, if you have any other questions, you know where to find us. Again, the 801-481-8840, you can reach out to us at that, or send us an email, but we would love an opportunity to help you. We have one more question, and then we're going to go ahead and wrap it up. First at 5%, and the second at 3%, and the first is being sold. Oh, I'm so glad you brought that up. Yay! Heather, thank you. That's a really good thing that we love to point out. Your interest rate on what we would do is we would give you lots of options. We would look at combining the first and second and see if combining the first and second is a good option for you, if the overall is going to drop your monthly payment. But we also want to look at what do you want to accomplish by this? Do you want to accomplish just lowering the rate on the first, or do you want to try and move the two of them, the first and the second, together so that you only have one monthly payment? But the biggest takeaway that I get there is to point out that we actually hold on and service our mortgages. And so if you do a conventional loan with us at the credit union, we're going to service that loan for the life of the loan. And so you're not going to be sold multiple different times. And those of you that have mortgages know what I'm talking about. So the big plus at the credit union is we're going to hang on to that and we're going to service it. So you're going to know who you're going to talk to for that entire term. I'm going to encourage, so if your goal is to combine them, we would love to run this scenario, Heather, and give you an idea of what would be in your, just give you some options to help you find a solution. That would be a great, and with your first at 5%, it sounds like it might be a really good option for you to combine them.
And the worst thing that can happen, and I've had this conversation numerous times with people, is that we would say to you at the end of it is that you're in the best possible position that you could be in. And
right.
I think that's great news, because then at least you know that you're in the best possible position. So we just want to go through and have these conversations with you. It's really, really quick to be able to do it. It doesn't take a lot of time, and we can make sure that we're getting you taken care of to the fullest extent.
Great. Thank you so much, Taylor. Thanks for your hard work on this. Thank you for joining us. We appreciate it. If you guys have any other questions, again, you know where you can find us. So have a great afternoon.